This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, June the 10th, 2014. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. This month I'd like to cover briefly a broad range of topics listed here. The bottom line to me is that I presently see volatility increasing between now and the June quadruple witch, with a major market correction likely beginning prior to the July options expiration and lasting into the fall. If you stand back from the markets, the degree of distortions we currently see is of historic proportions. Frankly, I've never seen anything like this before, including 1987, the 2000 dot-com bubble, and the run-up to the 2007 financial crisis. Corporate profits after tax are something we haven't seen since the Gilded Age at the end of the 19th century, but it isn't because of growth and investment, but rather from labor cuts, unprecedented low interest rates impacting non-operating expenses, and massive financial gearing. The apparent good news from this is that cheap money brings demand forward and thereby increases profit relative to fixed costs. Cheap money accelerates capital and IT-driven automation and cost efficiencies, and we see that in the profit. The reality is bad money, that is malinvestment, drives out good money. Supply then soon outstrips demand. The consequences? Artificial growth and unsustainable rates and returns. The inevitable adjustment is therefore extremely disruptive and painful. The financial gearing hasn't been limited to corporations, but also equally to investors, traders, and the growing legions of speculators. As John Houseman so eloquently described recently, and I quote, "Stock market peaks are a process, not an event or an instant. In the context of a full market cycle, that process seems fairly brief. In real time, it can seem endless. Avoid impatience and complacency." And that truly is the situation we're currently in. There is a very high probability that we could see a correction in the 15% range in second half 2014. So who is presently buying? We have known for some time who isn't. It isn't hedge funds, it isn't institutions, nor the smart money. Even though the private clients shown here appear to be positive, recognize on the chart that it is still in negative contraction territory. The public always comes into the market when it nears its peaks, but this time much less so than ever before. Investors pulled a net $921 million from the U.S. stock mutual funds in the weekend at June 4th, and $451 million the previous week, according to Lipper. But overall, U.S. stock funds still brought in cash since exchange-traded fund investors put more money into stocks and mom-and-pop yanked out. So who is buying? Twofold. First, it is unquestionably corporate buybacks. Enormous amounts of stock buybacks are being conducted by the S&P 500 companies. Last year, the S&P 500 companies bought $475 billion of their own stock, and in the first quarter purchased another $160 billion. Close to 80% of all the profits of the S&P 500 companies are being recycled into the hands of shareholders through buybacks and dividends. And this is probably the most powerful force pushing this market higher. You wonder why the market doesn't have any pullbacks? It's because the major corporations are buying on all dips, and they have got plenty of firepower with low borrowing rates. Buybacks are still projected between now and the end of the year to possibly be another $350 billion, which is truly significant. Secondly, it is a trading strategy of squeezing the shorts in a way that I can never recall happening before. It has become so prevalent, in fact, that a new ETF has emerged which targets exactly this strategy. The shorts appear, as a consequence, to be throwing in the towel and quitting. This leaves everyone on the same side of the boat. We all are acutely aware of what happens when everyone is on the same side of the same boat. Some pattern outcomes are blatantly obvious, especially when they are observed over longer periods of time, years, and with repeatable outcomes. Though they are often poor timing signals, they are clear roadmaps for those prudent investors who don't see themselves as speculators nor traders. J.C. O'Hara reports that the percent of stocks above their 200-day moving average in the S&P versus the percent of stocks above their 200-day moving average for the Russell 2000 exhibit spreads at their widest point in the history of his particular database. Currently, the average S&P stock is negative 5.5% below its 52-week high compared to the average Russell 2000 stock, which is negative 20% below its 52-week high, a very large discrepancy between the two indices. The S&P is at a new all-time high, while the average Russell 2000 stock is in a stealth bear market. Another way to measure breadth is to look at the percent of stocks above a certain moving average. This measure does a good job of compiling the bottom-up breadth of an index. Typically, the S&P and Russell track each other closely when it comes to this measure of breadth. Taking the study one step further, we measure the spread of breadth between the two indices, looking at the percent of stocks above their 200-day moving average in the S&P 500 versus the percent of stocks above their 200-day moving average for the Russell 2000, we find the spread is at its widest point in the history of the database. Examining the last 19 years of data, O'Hara finds the spread on average is approximately 7.5. The current spread is nearly 4 times as wide, registering 29.7 at the recent close, coming off its highest reading of 38.9 on May the 14th. The chart attempts to illustrate how the S&P 500 reacted to extreme spreads between these two breadth indicators. While we find breadth is not a proper market timing tool, a heightened reading often forewarns of troubles ahead. It was more common to alleviate a wide spread by the S&P pulling back to the Russell rather than the Russell playing catch-up. While it is in the Russell's power to catch up to the S&P 500, history suggests it is not a likely outcome. Whatever path these two indices decide to take over the next few months, investors should appreciate just how different the stocks in each group are behaving. Something is abnormal and uncharacteristic of conventional markets. Breadth readings confirm that the S&P and the Russell 2000 are two very different markets now. Brett Paletio research at Chapel Hill Research confirms the weakness in the market internals and indicates stocks can be influenced by macroeconomic factors and be adversely affected by tightening credit conditions. He chose the following criteria to prove his point: CAPE over 18, utilities smaller than 5% off 6-month highs, small cap stock underperforming large cap stocks by more than 5%, consumer stocks down 1% off 6-month highs, and rising Fed funds rates. If all of these conditions have occurred at least once in the past 3 months, a signal isn't given. And the last time we saw this signal was 2007, and the prior was 1999. So this is clearly a significant set of timings in regard to the market internals. The clock is ticking, and any sort of disruptive shock could give the equity markets a heart attack based on steadily worsening market internals. I believe we have some very clear and present warnings that an intermediate top is near at hand. The first is an old standby measure that I use of the New York Stock Exchange margin debt levels. Here, when margin debt demonstrates a parabolic profile, and that profile intersects the SPY pricing profile, we usually soon see a major correction. On closer examination, as shown on the right, we see that a sudden drop in margin debt usually is an early warning that the markets will correct. This is often a couple months in advance. The recent 2-month decline in the NYSE margin debt is the steepest observed in the data series since the SPDR ETF bear market in 2011. Something is brewing. Sentiment since the 2007 crisis shows a very telling profile also. Here, the investors' intelligence sentiment of bulls minus bears shows we are reaching an apex of higher tops and a parabolic increase in higher low reversals. Additionally, we see parallel correctional slopes throughout the profile. We have a little more to go, but we are nearing something that is historically very unusual. In major tops, normally the financial stocks will lead the way. They will break down sooner than the other generals. Here we see the financials versus the S&P X financials and some very clear reversal points. Currently, we have a rising S&P with the financials flat. If you divide the financials, which I've done here on the right, by the S&P 500, you can see that we have a very clear breakdown. Yet another interesting signal. I am not suggesting you trade from these charts, just that caution is advised. I have published and just recently updated, be patient, wait for the death crosses. To me, it is prudent to let the market give very clear confirmations that trends have reversed. One way is to watch the moving averages on various time scales for death crosses. These are crosses of specific longer-term moving average, which I lay out in the article on my site. The higher risk stocks, like the financials, will show you risk being taken off the table in advance of the generals being taken out to the woodshed. Here we see the NASDAQ leading the way, higher risk with moving average crosses, and as shown on the right, the Russell 2000 stocks being already down 22.3% from their 52-week highs. Risk is leaving, which I showed in more detail in my March article. Risk is leaving the market. Stealth movements warn of potential market troubles. On a longer-term basis, the monthly charts of the S&P 500 also need to demonstrate a moving average confirmation. One of those confirmations is to see the upper 2 standard deviation Bollinger Band plotted against a monthly moving average start to curl. This has not yet happened, and it can't really until minimally July. This suggests to me that we still have a little more time ahead of us if these all continue to follow the patterns they've historically followed. When I look at the calendar, I see some interesting dates ahead in July. We have a major Bradley turn date on July the 16th, a Phi cluster zone on July the 17th, and the July options exploration on Friday, July the 18th. Coincidence? Maybe. I don't know. Very telling, though. When we see the level of complacency we are presently seeing, with everyone on the same side of that boat, bad things can and normally do happen. The VIX is at the lowest level we have seen since 2007. A recent article in the New York Times pointed out that the Fed's actions have mirrored the fact that 76% of the largest one-day percentage moves over the past 40 years occurred after 1994. What is happening is the volatility is low, but when it spikes, it really spikes. In other words, when the shit hits the fan today, it really hits the fan. It has been 6 years since anything has realistically hit that fan. Even a minor correction hasn't been seen, at least recently, nor has it been allowed. If we look at the PEs divided by the VIX, it suggests that earning or a recession scare may be an event risk possibility. We just recently witnessed Q1 GDP revised to a negative number. What is the possibility of the July earnings season being a disappointment from the guidance standpoint, and everyone then thinking Q2 may also be weak? Some clever guy will quickly do the math and say, doesn't 2 consecutive negative quarters define a recession? Sell. This could all lead to some sudden protection covering. When greed gets this elevated, fear can also suddenly and abruptly arrive on the scene. I don't want to read too much into all these charts, but a correction now would be exactly what the Fed would want and needs for the bond market. Supply is being choked, and with demand surging with a flight to safety, it would drive bond prices up and yields down. Financial repression suggests this is exactly what we should expect if it is being successfully implemented. The Fed now controls the inventory, and the government has been shrinking the supply on a relative basis. With 10,000 baby boomers retiring daily and an $84 trillion unfunded entitlement problem, the government will soon need lots, and I mean lots of cheap money, and the cheaper the better. When stock prices go up, as they have been, it makes yields worse for stock yields, and therefore even ridiculously poor bond yields become relatively attractive. Driving the stock market up actually helps bonds become more attractive. The excess earnings yield, that is the difference between the stock yields less the 10-year bond yield, has spiked higher and appears to suggest a correction might now be in order. The Fed and central bankers may, in fact, have a very clever strategy going here. I'll let you be the judge on that. I've written for some time now that I am expecting a correction which will force more central bank actions before igniting a final long-term top into 2015. This year's strategy document on the globalization trap lays out the basis for this chart and the thinking behind it. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2014 turn out to be an outstanding investment year for you and yours. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.